G'day guys, welcome back to the Devon Too Good Investing channel. Well, it's been a while since I made my last YouTube video. It's probably been about 5-6 weeks. And first of all, I just want to thank anyone who's watching this video today, particularly if you're a returning viewer. And if you're new to the channel, welcome. Make sure you subscribe because I'm going to be coming out with more videos in the future. But anyway, the reason why I have not released a video for the last 5-6 weeks is because I've been focusing on a different project, and I've actually been working with a business partner of mine. He's also a good friend, and that particular project is called Structured Dividend Capture, and it's actually a different strategy of investing. And I came across it through Matt Peterson. He is a fund manager over in the US, and he's got many presentations about how the strategy works. And pretty much, I think there's big potential in implementing that strategy, particularly with your leftover cash that isn't compounding in these great businesses. I think there is some big opportunity, especially with the volatile markets at the moment. Pretty much the more volatile the market is, the better the strategy works. It involves selling a put, capturing pretty much a dividend, and then selling a call to get out of that stock, and you rotate through a basket of stocks, and that's pretty much the strategy. But we're working on that strategy at the moment. We're building out a pretty sick Google Sheets file with a list of stable dividend companies, and we're trying to build a Gantt chart with ex-dividend dates, when to buy when to sell the puts, so we can collect the dividend and then sell a call to exit the position. Anyway, guys, that's probably not why you're here today, but that's what I'm up to. Perhaps I'll talk more about it in a future video if we can get the strategy rolling. The reason why we're here today is to talk about Meta earnings. So they came out with their earnings. The stock popped like crazy. It went up like 20% in the day. And let's just get right into it. So right off the bat, we can see that revenue fell 4% year over year for the fourth quarter of 2022. You can see they did a bit over $32 billion in revenue. And we can see that in general, if we look at the user geography, or the revenue by user geography, you can see that the rest of the world, it actually grew. So this is regions such as Africa. We're seeing revenue growth there. But in regions like pretty much every region, Asia Pacific, it fell. Europe, it fell pretty big. And then you can see in US and Canada, fairly resilient, pretty much flat. So revenue fell. This is mainly due to a weakening advertising environment, as well as the shift from feed ads over to real ads, and Meta trying to work out how to monetize reels, essentially. So if we look at the segment results, we can see that advertising makes up the very large majority of Meta's revenue. And we can see that this part of the business did decline slightly year over year. And if we have a look at the Reality Labs revenue, this is kind of concerning, honestly. It didn't grow year over year. So, look, it's obviously early in the process here of growing Reality Labs. I don't want to bake too much in too early. However, obviously it's not growing. It's not a great sign, to be honest. If we look at the family of apps, operating income did decrease. It went from 15.8 billion down to 10.6 billion. And then we can see the losses for Reality Labs increased roughly, call it 25%. And they had a loss of $4.2 billion. If you take the 10.6 billion, or if you get the 10.6 billion and take the loss of 4.3 billion, you get $6.4 billion in income, or income from operations, which led to a gross margin decrease from 37% all the way down to 20%. And pretty much some of the reasons for this is, as we said before, the weakening advertising demand. We can see the headcount has expanded. Obviously, Meta are doing some layoffs, but if we can compare fourth quarter 2021 to fourth quarter 2022, the headcount has increased a lot. Off the top of my head, I think it increased, around 30% year over year. Obviously, the more employees you have at the company, the higher your expenses are going to be. And we can see that's had a negative effect on margins. Another reason is the revenue shift to Reels, which monetize at a lower rate than feed. Obviously, for every ad on the feed, it creates more revenue than every ad on the Reels as part of the business. So because of that, we're seeing margins come down as well. Obviously, greater reality lab losses, as well as a heavy investment into AI, which is actually paying off. We'll talk about that later when we get to the analysis of the conference call. But you can see that net income as a result fell 55% year over year. Now, in terms of diluted earnings per share, instead of, we can see the net income fell 55%. Well, the earnings per share fell 52%. The reason for this is, obviously 52% is, it's not what you want to see. But the reason why it fell less is because they've been doing share buybacks, and in the earnings call, the company announced that they're going to be doing, or they have been authorized to complete a $40 billion share buyback program on top of the $10 billion of their already authorized program. So they've got $50 billion in share buybacks authorized at the moment, which we will see them execute over the next couple of years to bring that share count down essentially, and increase your per share earnings. In terms of capital expenditure, it has increased quite considerably year over year. This is due to the metaverse spend, and more significantly the AI spend. So pretty much they're buying data centers and building these things out, and pretty much trying to make their advertising better on a, that's very high level sort of brief way of explaining it. But the company did say on the call that they are going to pull back on capital expenditures. It's only going to increase slowly over the coming years. That's what the company is, pretty much coming out and saying. So we can expect CapEx moving forward to grow just at a slower rate, essentially probably flat. But we'll see what happens there. Family daily active people. This is very promising. It grew 5% year over year, and quarter over quarter, it also grew. It shows that the fundamentals of the business are getting better. There's more people using Instagram and Facebook, WhatsApp, and Messenger than there was last year, so that's always a good thing. The same story remains with monthly active people. That was up 4% year over year. Now, family average revenue per person, we can see this decrease year over year. And why is this? Well, we've already pretty much discussed this. It's mainly due to a weakening advertising demand. Pretty much advertising on Meta works in an auction-based system. If there's less demand to purchase ads, well, the ads are going to be cheaper, as well as Reels becoming a bigger part of the business and Reels monetizing at a lower rate at the moment. Free cash flow, we can see that it pretty much got more than cut in half. There's pretty much two factors that determine free cash flow. It's your net cash provided by operating activities and your purchases of property, plant, and equipment, essentially your CapEx. And you can see that due to weakening advertising demand and Reels monetizing at a lower rate, there's been a decrease in net cash provided by operating activities. And then if you look at the CapEx, due to the higher metaverse spend and the higher AI data center spend, we can see that expenses or CapEx here have increased, which in turn leads us to a lower free cash flow of $5.2 billion. So if we now talk about what's going on here with the conference call, Mark Zuckerberg comes out and he says that they want 2023 to be a year of efficiency. Essentially, they want to restructure some of the business and spend less on capex. They're doing layoffs and restructuring some teams. They're also flattening their organizational structure, which includes removing some layers of middle management, which should lead to making faster decisions, hence becoming more efficient. They're also looking to cut projects that aren't performing well, and his overall main focus is on increasing efficiency. In terms of AI, the AI they're pretty much investing heavily into AI, and they're trying to show more relevant content recommended by the AI systems, which is on Facebook and Instagram, and this is really them trying to push Reels. So there has been some good news with Reels. So Reel plays across Facebook and Instagram have more than doubled over the last year, while the social component of people sharing Reels has grown even faster, and it has more than doubled on both apps in the last 6 months. They're also seeing that this is one of the issues, right? So they're focused on growing Reels. So they're focused on growing Reels and improving monetization efficiency. Currently, the monetization efficiency of Reels is much less than Feed. So the more that Reels grows, even though it adds engagement to the overall system, it takes away some time from Feed. And as a result, because of the lower monetization rate, this causes Meta to actually lose money. So pretty much they're working hard on increasing the monetization efficiency on Facebook, and pretty much with Reels on Facebook, the monetization efficiency has doubled in the last 6 months. And then in terms of revenue headwind, Mark Zuckerberg says they're on track to be roughly neutral by the end of this year, maybe early next year. And then after that, they should be able to profitably grow Reels, which is a big development for this business. So furthermore, in the broader business, or the broader ads business, as we mentioned, they're continuing to invest heavily into AI, and they're saying that their efforts here are paying off. And in the last quarter, advertisers saw over 20% more conversions than in the year before, which is great because pretty much the more effective the ads business is on Meta, the greater their moat is going to be, and the less likely businesses are to use some other advertising service. They're also talking about the monetization of business messaging, and they're saying that their click-to-message ads now run at a $10 billion annual run rate. Also promising is paid messaging, and this pretty much exists on their WhatsApp business platform. So they're finally trying to monetize WhatsApp, which is great because WhatsApp has 2 billion users. And if they can pretty much start making money from WhatsApp, it can be, you can call it another stream of potential revenue growth and, free cash flow in the future, although it's still pretty early days here. So in terms of guidance, they're expecting $26 to $28.5 billion of revenue, and this assumes a foreign currency headwind of 2% to year-over-year total revenue growth. In terms of expenses, they're lowering their expense range from 94 to 100 billion down to 89 to 95 billion, and this is due to a slower than anticipated growth in payroll expenses, as we mentioned. They've cut hiring and they've actually done some layoffs. And they're also sort of consolidating some of their office footprint. And instead of it costing $2 billion to sort of consolidate their office footprint, it's actually going to cost them $1 billion. So there's a $1 billion saving there. And then in terms of capex, they're looking at a capex range of 30 to 33 billion, which was lowered from 34 to 37 billion. And this outlook largely reflects their plans for lower data center construction spend, which will in turn reduce capex. Now, guys, let's quickly have a look at a valuation here. So I've updated my valuation for Meta. This is a sum of the parts valuation. Pretty much I've split the business segments into their own individual segments, and I've valued them all individually. At the moment, they have net cash of about $14 per share. I've valued WhatsApp at about $15.50 per share, and this is based off the number of users that they've got, and essentially comparing that with the purchase price of the company back in 2014. This is very rough here, but conservatively, we can say that WhatsApp's worth about $15 per share. I have applied a margin of safety here of 50%. The same here with Messenger. There's about half as many users on Messenger as there is on WhatsApp, and applying that same 50% margin of safety, we get a value of about $7.65 per share. For now, I've valued Reality Labs at 0. It's very speculative. It's very hard to value. I don't know if it's going to work out or not. And then I've valued the Instagram and Facebook part of the business at $242 per share. And this is based on 2022's operating income of Facebook and Instagram of $42 billion and a multiple of 15. So I guess that's a total value of $279 per share. And then I also wanted to do a deduction for the metaverse spend. So then Reality Lab loss for 2022 was $13.7 billion, which equates to a loss of $5.20 per share. Over the next 5 years, I'm going to assume that the Reality Lab expense grows at 15% per year. So the loss per share in the year of 2027, I'm estimating it to be about $10 a share. The current share price is $186. So if we grow the business out, if we account for the deduction for the metaverse spend, and we assume a 8% growth rate for this total value of the business here, we get a 2027 share price of $395, which is a CAGR of 16% from the current share price. So guys, that's my valuation. This is my update on Meta for the Q4 2022 earnings. I'd say the earnings, lawyers, is pretty much as expected. We were expecting revenue growth to be a little bit negative or flat at best. Margins were hit pretty hard, which resulted in lower free cash flow. Meta in general were quite slow to curb their spending. As a result, we saw those margins come down. However, it looks like a lot of the money that they're spending on the advertising business is paying off, and they are making progress with monetizing Reels. So overall, just looking forward, it looks more positive. I think the worst of this is probably behind us now, and hopefully we can have better business results moving forward. But anyway, guys, thanks for watching. Make sure you subscribe. See you in the next one.